you need to understand why is the price where it is, where it will go next, and the best indicator is the price itself. You can trade using moving averages, you can use stochastics, you can trade using RSI, you can trade using many indicators. But I always say the best indicator is the price, and the price is, you can see the price through the candlesticks. So if you understand candlesticks, you will understand the price, the reason behind the movements. What actually moved the market is not the same as what most people think it is. So basically, we've got a simple strategy. What we do, we buy low and we sell high. That's all we do. As a trader, you want to buy something when it's cheap, you want to sell when it's expensive so you can make profits. Or you want to sell when it's highest, it's very expensive to make profits. That's all you want to do. The reason you're buying low is because your analysis is telling you it's going to go up. The reason you're selling when it's high is because the analysis is telling you that it's going to drop. So that's all you do basically. And then what pushes the price is the supply and demand. Whenever there's something, the price is high, more likely the demand will drop. Whenever the price is very high, chances are there's a lot of that thing, a lot of people don't want it anymore. So basically there's a huge supply. So on this side you see quantity, and on this side you see the price. So what happens is that if you are selling something, there's a huge demand for it, chances are the price will go up. When the price is low, when there is a huge supply of instruments you are selling, chances are the price needs to drop. That means you're going to be selling. So in the supply zone, you're looking to sell it. In the demand zone, you're looking to buy it. You only buy at the demand, you only sell at the supply, unless there's a swap zone where the demand becomes supply. That's where you're looking to buy or sell. This is a market structure. What actually happens is the market will go up to reaching the high, which is H, and then creates that high, and then dropped again, creating the low. When it break that high, that's where you see the resistance now becoming support, which is here, and then you find creating higher low. This is what we call an uptrend. When the market is breaking these highs, breaking the highs, creating, this is the retesting, coming back to this zone. This is an uptrend. And then when it's dropping down, this is now a downtrend. In a downtrend, you're looking to enter here for sell, coming back here for sell. In an uptrend, you're looking for here to buy, coming back, retest, buy, retest again, buy. That's all you do. The market structure is what will tell you the story, basically. So that's all you need to understand regarding the market structure. What are the candlesticks? The candlesticks basically in the chart, they provide information of they give you four prices: the high, the close, the opening, and the low. This is when the price actually went up. This is the highest price it went to. This is where it closed. This is where actually the opening price is, the lowest price it reached. When the price dropped, which means went down, this is the close, this is the lowest price, and this is the opening price because it's dropped, and this is the highest price it's reached. So basically you see 4 times of prices: opening, high, close, and low. But what is important is you should understand that a candlestick can represent a month on a monthly time frame, weekly on the weekly time frame, a day on a daily time frame, or it can be a 4-hour, or it can be 1 hour, 30 minutes, 5 minutes. Basically, this type of a candle means the price actually went up. This one means the price actually dropped. So what you look for, the price provide information based on the time frame you are looking at for the price. So basically, you really need to master 3 type of candlesticks if you're going to be trading supply and demand strategy, or you're going to be trading Quasimodo, or you're going to be trading head and shoulder. You only need to know these type of candles. Basically, the DOJI candles are the one with, you find the small body. So this is the body of the candle, the small body, and this one is more likely to indicate indecision, which means there's going to be a change. It's going to be a reversal. It's going to be, this is a very, very important type of a candle to understand. You'll see that whenever there was this candle, something happened to the price. So what you'll see that in this case, the opening and the close are more likely the same. So this is basically where it's basically the supply and demand are in balance. So that's what you understand about the doji candle. Indecision is very important candle. You see them on the reversals, which means they're on the demand, they're also on the supply, also on breakout. And then the shooting star, this one shooting star is basically a bearish reversal. It's where basically on the top, which means this huge week, which means there was a rejection in that highest level and the price is gonna drop. So what you see that, which means here you find that the price push up, but then because the sellers were in control, the price actually dropped. So what you see, this is a bearish reversal pattern. The long wave at the top shows that the buyers were in control until it hit a price indication. There was a price here that the price went to and rejected, and it dropped big time. So but then it price dropped. So what you look for when you see this type of candle, you're also looking for a selling opportunity most of the time, especially if it's on the supply zone. What you do is buy and sell. You buy at demand and you sell at supply. In the hammer, this is a bullish pattern, which means you find that there was a price that was reached here. What happened here is that the buyers took control. What happened? The price dropped, reached a certain level, and the price started going up. So you should understand that the psychology behind this is that there was a point where there was a huge demand here, so the price just tapped on it and actually went up. So this more likely, if it's on a demand zone, the price gonna reverse and actually go up. And then this, when you add these two candles, you see a bearish engulfing pattern. This one here, which is your shooting star. When you add these three, also you see the same one, which is your shooting star. Basically, same story here, a hammer, a bullish engulfing. That's here, hammer, and then same story here. So those are basically the important candles you should master. So it's very important when you are trading. So those are the key things you should understand. If you go and look at the chart, basically you will see this is AUD and ZD is a daily time frame. Like I said, a chart can represent a day. So this is a day, another day, another day, another day, another day. But what is important is the shape of the candle. So what you should understand is the shape of the candle. So this one is a doji, as you can see. This price dropped, and then this one's here is what we call a bearish engulfing. This is a bearish engulfing. As you can see, this was a huge drop after that candle was formed. So what you do is, in that case, is just use this here. As you can see, the price is gonna come back here, then drop again. As you can see. So these type of candles, like this one here, is another one in hammer. So this one here, it's a doji but shaped like an hammer. So these are the one the price will come back and retest and then go higher again. Like this one here, this is another what you call this, shooting star again. The price went to that level and then dropped again. So what you look for is that these levels come back, dropped about over 100 pips. So that's why I'm saying it's important. It's a key level where you understand about the shape of the candle and also how it your understanding of your supply and demand zone. So this is another one, doji candle right there. This is another candle right there. Very key in terms of your supply and demand trading. So what you need to look for, can you check this? It tapped this zone. This was a huge drop to this zone, then come back again. So this was a very dangerous hammer. But the more you study that, what is important is what the candle is. Not necessarily that's important when the what do you call this? When the shooting star is here, is very key. When the hammer is here, is very key. Which means if it's here in the middle run, it's not really important. What is important is that where about is it regarding the price or regarding the zone of the candle is on the demand zone or the supply zone. So what you look for is this type of candles on the demand or the supply zone. That's what you're looking for basically. You wanna trade or buy at demand and sell at supply.